Good afternoon, everyone. This is Corey Hinkle here with your Ankerstar Wealth Daily Update. We've got an exciting show for you today. We're going to look at some second half of the year predictions for the stock market. We're going to look at just how volatile the 2020s have been as a decade. And we're going to look at an AI dilemma part one. I've got actually two parts, two different AI dilemmas that have been stewing in my mind. And I'm bringing you part one today. We'll get to part two another day. But first, this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and mine alone. All right, let's bring in just the S&P 500 today, get a little market update. So today, the market's just extremely flat. We had a big up day yesterday, up greater than 1%. We're about 1% from all-time highs at this point. You know, and depending on the stock, some of our larger holdings may be a couple percent from all-time highs. There's a few that have been already hitting all-time highs. One of them hitting all-time highs today. So some interesting stuff that we'll look at there. But yeah, you know, the market is just flat today. Very bullish undertone to what's been going on out there in terms of price action. Wanted to take a look around the S&P 500. We don't do this every day. You know, you can see where's the money flowing today, right? You're seeing, is money flowing to defensive names? No. Is money flowing to energy or utilities or industrials? Not really. Money is flowing to tech and almost exclusively to tech, with financials as well. So the bright green big one over there, NVIDIA is hitting an all-time high as we speak. So all-time highs today, 52-week highs. You know, there's been a lot of strength in that part of the market. We kind of expect that to continue, whether that be an AMD, whether that be a Broadcom, whether that be an ASML or even a Taiwan Semi. There's a lot of things, anything tied to the semiconductor space has probably been seeing some strength recently, and will probably continue to in the coming weeks as the market continues going higher. Okay, what else is moving in the market today? I thought this was funny. Bumble, which is a dating app, was jumping 26% as they axed 30% of their workforce. Samantha wrote this article here. Why did she not say as the company breaks up with 30% of their workforce? What a missed opportunity here. But, you know, it looks like Bumble stock likes when the company is breaking up with their workforce. And I imagine that Bumble as a company probably also likes when people are breaking up with their significant others and going back to using their service or a similar service out there. So I just thought that was a funny story. Bumble was about an $8 billion company at one point. It's well under $1 billion at this point. They have some issues. It's trading kind of at that dirt cheap valuation, and you know, it's hard to really predict where that business model will go in the coming years, given the competition and some of the other things that they're dealing with. Okay, I wanted to highlight this from Joseph Carlson from A Wealth of Common Sense. That's his blog, so I want to give him a shout out for this work. He shows in red there, that's the 2020s as a decade, and he's looking at the total number of 1% up and down moves over the course of a decade. Now, what's unique about the 2020s is that we're only halfway through the decade or so. We've got a long way to go in this decade, but as things currently sit, it's already past the 1960s, which is a complete decade, and the 1950s. It's about to pass average, and then it's likely going to be either the second most volatile decade ever or the most volatile decade ever. And in the case of the S&P 500 so far, or the market in the 2020s, that volatility really has been a gift to investors, even the volatility we've seen this year. It allows investors to reinvest those dividends at slightly lower prices, to stack up some additional purchases at slightly lower prices. And all the while we're sitting right at all-time highs, which we just looked at. So the volatility has been a gift. The volatility in the most volatile decade ever was not a gift. In the 2000s, the volatility represented pain and struggle for the market trying to move higher. So, in the case, in our experience so far, it's been a gift, and we'll see how the rest of the decade plays out. I want to highlight one more thing that he mentioned on this next slide. So this is Joseph Carlson. He highlights that bad things do happen during those volatile periods. And then he says, think about all the stuff we've gone through this decade: the pandemic, the meme stock craze, 9% inflation, the Fed jacking up rates from 0 to 5% in a hurry, the Silicon Valley mini banking panic, the yen carry trade blowout, Liberation Day, and all sorts of other things. The booms and busts seem to be happening faster than ever. And, all the while the market's moving higher. And why has the market been moving higher? It's that same reason we've been hitting on for a few weeks. And obviously in the last couple of years, it's dominated the news cycle. But BlackRock's Rick Rieder also agrees with the same sentiment. And it's all around the impact of artificial intelligence on companies' ability to generate profits, increase margins, increase productivity, and so on. Basically just to better execute and practice efficiencies that weren't possible before. BlackRock's Rick Rieder is confident in equities in the second half of the year. So he views AI as a deflationary force in the market. So it's going to be through those efficiencies. It's going to be making things cheaper on the company side, potentially even flowing through to consumers. Now, with that, so you've got the companies benefiting from it, potentially the consumers benefiting from it. We'll see how much of those benefits filter through to consumers. But regardless, even if none of them did, it would still be good for the stock market in a sense, and it would still be deflationary in a sense, because it would restrict other inflationary pressures that may exist outside of what AI can work against to offset. So he views AI as the greatest technology revolution ever. I think we're getting there. AI as it currently sits, if you go to ask an AI right now, and now we're going to get into the AI dilemma part 1, but if you go ask an AI right now if it is capable of independent thought, or if it is functioning more as like a word calculator of sorts, an advanced word calculator, the AI would tell you that it leans much more to the word calculator version than an actual independent thinking entity. So it's really recognizing patterns. It's able to find the benefits of certain patterns, and it's able to regurgitate those things to you. It's able to simplify things, and it's a good teacher, but it's not all the way there as far as thinking from an independent basis. So, but here's what Rick Rieder was talking about. You've got Amazon, Microsoft, Intel, CrowdStrike, all of these companies citing AI as a reason for layoffs or workforce reductions. So of course this is deflationary, but it creates a dilemma. Where are all these people going to go? Now, the general consensus is that AI, every technology ends up creating jobs at the same time as it destroys jobs. So for example, the technology, of the advancement of electricity, or in using electricity for industrial reasons or for home reasons, residential reasons, all of those things, it took away quite a few jobs. that were had to be done using, manual power by humans. But new jobs were created as well. So is AI going to end up creating more jobs potentially in service industries and things like that? It's highly likely that that will be the case. The dilemma is we're seeing layoffs take place right now. These layoffs will likely continue, will likely also accelerate. The question is, how quickly are new jobs created as a result of this? Is there a lag there in between the two? Now, this is a more minor dilemma compared to my dilemma part 2 that I'm going to share in a couple of days, but nonetheless, it is a dilemma. And also, sorry, as Rick Reeder views it from BlackRock, a benefit to markets in the second half of the year. And I agree with him there. I would be, as I've mentioned multiple times on the show, I would be more afraid to be underinvested right now, given the technological advancement, versus being overinvested right now. So that's our market update for today. We haven't quite gotten back to all-time highs yet. Maybe this week, maybe next week, but it should be there soon. And that's all we have today. So have a good day, and we'll see you tomorrow.